All right. Well, I think with that we'll get started. I'm Jacob Milosek. I'm a tax partner here at Hendry Warren, and happy to be joined today by my colleague Nick Raycroft. Nick is a principal in our tax group that he and I work closely together. And if anyone attended our webinar last year, you might remember that he and I gave a similar kind of talk or update last year. So excited to be back, and we're going to cover off what we think are some topical issues for people. I realize people are busy, and I wanted to start by thanking everybody for your time today in joining us. We hope this is helpful for you. We are going to ask that if you do have questions along the way, feel free to post those in the chat, and we'll try and address as many of those as we can. But in the interest of everyone's time, we're going to try and keep our presentation to roughly half an hour, and happy to address questions at the end. You see on the screen here that there's a QR code and this menti.com website with a specific use code that you can enter. If everyone could take a minute and just try and sign in to menti.com and use this code, or if you're so inclined, you can use the QR code. We have tried to add in some interactive questions, and obviously the more uptake we get from the audience in addressing these questions will make it more meaningful. So the website and the code are going to be on some following slides, just in case you run out of time trying to get logged in. So with that, in terms of today's agenda, we're going to cover off a couple of important things. So payment and filing deadlines, and interestingly, this year there's some changes there that we want to make people aware of. I'm sure everyone's heard about some of the back and forth saga that has been the capital gains inclusion rate changes. We're going to talk about that. There's a handful of other tax changes that may be impactful to you and your family for 2024. There's a whole host of different topics related to real estate that Nick and I are going to cover. And then Nick's going to take over and talk about deductions, pension splitting, and the disability tax credit. So these are all things that we get a lot of questions on from clients during busy season, and we felt like these were good topics to cover off today. So with that, hopefully everyone's had a chance to get signed into Menti. Again, if you haven't, the website is menti.com, and the use code is at the top of the screen. Our first question here is, how knowledgeable do you feel about personal taxes? So thank you to those who've signed in. Looks like we've got some responses flooding in. So some folks are saying somewhat, others not very. And what I'd say is that's where Nick and I feel like this type of presentation, hopefully we can help you feel more knowledgeable when you walk away at the end of the presentation. Second question that we have for everybody is, what interest rate is CRA currently charging on unpaid tax balances? So kind of a wide variety of responses here. The correct answer is actually 8%. So that the interest rate that gets charged by CRA is tied to the prescribed rate of interest. So it moves and flows depending on what interest rates are doing. And more recently, interest rates being what they are have been a bit higher. And so as a result, we're now stuck with 8% interest. It's worth noting that interest is non-deductible. And so 8% sounds punitive, but when you also add in the fact you can't deduct it for tax purposes, you in effect would need like a 16% return on investment, pay half to tax to be left with money to cover off the interest. So it's a pretty punitive interest rate. Because the rates are so punitive, understanding your payment and filing deadlines becomes very important. So as a general rule of thumb, the payment deadline for any personal tax that you're going to owe is going to be due April 30th. There are some exceptions if somebody's passed away or whatnot, but generally April 30th is the day that the tax needs to be paid. For most of taxpayers, the filing deadline is also April 30th. that filing deadline gets extended for those that have self-employed income. So if you've got a small business that you're operating personally, that filing deadline of the return gets extended to June 15th. But it's important to note that any taxes owing are still actually due and must be paid by April 30th. And so the question that often comes up is, well, how do I file my return by June 15th, but know how much tax to pay by April 30th? And you either have to come up with a bit of an estimate and remit what you think you're going to owe, or what we recommend to folks is that generally it just makes sense to try and get your taxes done and filed by April 30th so that you know exactly what to pay. You always want to be mindful of HST. So if you're self-employed, you'll also have an HST filing requirement likely. So there's deadlines there to be aware of that mirror the personal tax filing deadlines. And the other thing to note is installments. So even though your tax payment due date is April 30th, typically, the government kind of assumes that your income in year one is going to be the same as it's going to be in year two. And because of that, they want to get their pound of flesh a little earlier, so to speak, if they can. And so they've got this system whereby quarterly tax installments are due in March, June, September, and December. And generally those installments are due based on what you owed in the prior year. So just be really mindful of possible installment requirements. Typically that's going to kick in if you owed more than $3,000 in the previous year. So those are what I'd call the standard regular deadlines. New for 2024 only, CRA's announced some penalty and interest relief. And we're going to talk about the capital gains changes in a second. That's really the crux of why this relief is being provided. But what CRA has said is that administratively, they're not going to assess penalties or interest where a taxpayer has filed and paid their tax balance owing by June 2nd of 2025. Sounds great, right? So this is good. They're giving this relief. My concerns are well, I've got a number of concerns. The main one being that this is an administrative thing that CRA has said. And so nowhere in the legislation does it somehow say for 2024, you will be absolved from penalties and interest if you file by June 2nd. This is CRA's administrative position, which in theory is subject to change at any time. My other concerns here, though, are that these rules apply for what they're calling impacted T1 filers. So my question there is, well, who is an impacted T1 filer? Presumably, because this penalty relief is being extended because of the issues with the capital gains changes, presumably it's going to be somebody who has a capital gain that they're reporting on their personal tax return, which would make sense. But would that same extension apply to somebody's spouse, for example, who maybe doesn't have a capital gain while their spouse did? Very unclear at this point. And the other thing that's unclear is whether any other related forms or filings or elections that might be related to the filing deadline would also be subject to relief. So the perfect example would be the T1135. So the T1135 is a foreign income verification form. If you've got certain foreign property, it has to be filed with your tax return. And normally that form would be due April 30th. So it's nice that they're granting penalty relief for the personal tax return. Unclear if that same extension applies for the T1135 and other related forms. So my advice to folks is that although this penalty relief is available, certainly what we're telling all of our clients is that if you can file and meet the April 30th filing deadline, that's certainly our recommendation, because that's the best way to guarantee that you're not going to be dinged penalties and interest. So what caused this kind of extension in filing is really to do with the capital gain reporting. So in March of 2024, the government announced that effective June 25th, 2024, the capital gains inclusion rate would generally increase from 50% to 2/3. And this was going to apply for individuals, corporations, trusts, and all other taxpayers. Now, there were some special carve-outs that would apply to individuals, namely that if their capital gain was under $250,000 in a given year, they'd still benefit from the 50% inclusion rate. However, for all intents and purposes, there was a dramatic shift in the rate that was going to apply to capital gains. When these rules were first announced, I was scratching my head saying, well, why on earth did they pick June 25th, 2024 of all days? And when we did the math, it was exactly 10 weeks from the date of the federal budget. So I guess in the government's mind, 10 weeks was sufficient to allow people time to figure out, do I trigger a gain or do I not? It's unclear to me why the date of January 1st, 2025 wouldn't have been used, because that would have had the same effect of allowing people time to figure out their capital gains, but it would have greatly simplified the tax reporting. Along the way, over the past year or so, we've been working with clients trying to help them sort out their affairs. You know, do they trigger a gain? Do they not, etc. And all of this was kind of for naught, because on January 31st, 2025, so just recently, the Minister of Finance announced that because of some of the political uncertainty that's happening right now in Canada, these rules that were drafted, never actually enacted into law, the rules that were drafted would be put on hold until January 1st, 2026. So that in a sense is good news for taxpayers, because it kicks the can down the road until when we have to worry about these rules. And it also assures us that for 2024, we don't have to worry about all the complications of kind of a mixed year of capital gains inclusion rates. Unfortunately, you can imagine behind the scenes, CRA has created a number of forms and slip reporting and stuff on the basis that there'd be kind of two buckets of gains during 2024. And all of the software companies like the TurboTaxes and Tax Prep, who is our software provider, they went and updated their systems to reflect these new forms and this new reporting. They're now scrambling to make changes to the inclusion rate based on this recent announcement, which is what's causing delays on software systems being updated and ready to go to allow people to e-file returns under this new 50% inclusion rate. And that's really why we're seeing the penalty relief that was mentioned. So it's uncertain at this time what's going to happen. We're told January 1st, 2026 is when these rules will come into effect. A lot of that hinges on what happens if there's a federal election. And it's unclear to me if the rules as currently drafted are what we're going to see as of January 1st, 2026, or if there'll be some variation that's kind of adopted between now and then. So all that said, stay tuned for more on capital gains. I'm sure we're going to hear lots about it in the coming months. Some other changes, just very quickly to go through for 2024, alternative minimum tax or AMT. Don't want to spend a whole lot of time here other than to let you know that there's always a regular calculation of tax, and in the background, there's always this concept of AMT that calculates in the background. Now, historically, for most taxpayers, this has been a non-issue. And going forward, I would say for most clients, AMT will not be an issue. But where it will kick in is that if you've got income over 173,000 and you're receiving income with some type of benefit, so maybe a capital gain at a 50% inclusion rate, a stock option benefit, etc., those types of tax preferred things may now trigger AMT where they didn't in the past. So something to be mindful of, particularly for high net worth taxpayers. The donation filing deadline was extended to February 28th, 2025. There's a typo on the slide there, 2025. So because of the postal strike in November and December of 2024, the government kind of said, well, this may have impacted people's ability to get donations to charities. We're going to extend that deadline to February 28th of 2025. So what that means is that if you made charitable donations in the first 2 months of 2025, make sure your accountant's aware of those. They can be included on your personal tax return for 2024. A reminder about FHSA contributions. Again, don't want to spend a whole lot of time here other than to say this is a new account as of last year. And it's kind of the best of both worlds because you get a deduction on the way in, much like an RSP, and it's not taxable on the way out, similar to a TFSA. There are some requirements here to be able to open an FHSA, namely that you've got to be 18 or over, you've got to be Canadian resident, and you've got to be a first-time home buyer, because that's the whole point of this planning. But I wanted to note that you don't automatically accrue contribution room the same way you do for your TFSA, for example. So it's really important to go and open an FHSA account so you can start accumulating room. The last point here is that with all the capital gains changes that were proposed and then reversed, one of the things that's positive for taxpayers is that the capital gains exemption has increased to 1.25 million as of June 25th. Then the government's confirmed that that will hold true. Now, the capital gains exemption only applies for certain private company shares. And so for most taxpayers, this isn't going to be impactful. But if you do own shares in a private company and you sell those shares, then certainly this change to a $1.25 million capital gains exemption is good news. We also want to talk a little bit about things in real estate to be aware of. Everyone's relatively comfortable with this concept of the principal residence exemption, but just a quick recap is that in order to qualify as your principal residence, the property must be ordinarily inhabited during the year, and it must be capital property. So if you're in the business of buying and selling homes, that wouldn't be capital property, it would be kind of inventory used in a business, and it wouldn't qualify as your principal residence in that context. But provided you meet these kind of criteria, you're able to designate the property and shelter it from any capital gains recognition when you sell the property down the road. You can only designate one property per year. So somebody with a house and a cottage, for example, would have to look and evaluate, well, which property am I going to designate per year? The nice thing is that the designation only needs to be made in the year of sale, or perhaps when there's a change of use. And Nick's going to talk about the change of use rules in a second. And so it's something that you can kind of evaluate down the road when you do have a tax triggering event. And normally what we'd look at is, well, how much of a capital gain is accrued on the property? But more importantly, how much of a capital gain has accrued per year? Because that'll help drive the decision of what property makes the most sense to designate as your principal residence. So even though a lot of people look at the principal residence and say, okay, well, I've only got one house. I know it's exempted. I don't have to worry about reporting this on my tax return because I'm not going to pay any tax anyway. The real caution I wanted to drive home here is that as of 2016, you now have to complete Form T2091 and complete some information on Schedule 3 of your tax return. And if you don't, there's penalties that can apply. So even though there may not be an income tax that results from the principal residence disposition, there's a reporting obligation that goes with that. So our next Menti question that I'd open the floor for the group. What is the maximum penalty that Mr. and Mrs. homeowner would be charged if they fail to report the sale of their principal residence on Form T2091? Now, let's assume that this property is jointly held. So Mr. and Mrs. homeowner each jointly own the property. And so in theory, both of these people would have to complete the T2091. So a few folks jumping on for the second born child. Perfect. Yeah, so the correct answer here is $16,000, believe it or not. The penalty for not reporting the T2091 properly is $8,000 or $100 for each month that the form is late, whatever the lesser amount is. So where you have a couple that jointly own a property, the maximum penalty would be $8,000 times 2, so a total of $16,000. We've had some experience here. Unfortunately, CRA does not allow us to use their voluntary disclosures program to come forward when this has been missed. And so what I would say here is that in a year where you're doing some change or some sale of your property, you really want to be considering making sure that you get this form filed correctly and on time. Otherwise, the penalties can be pretty significant. With that, I'm going to turn it over to Nick.
Thanks, Jacob. So with in one of Jacob's slides, he mentioned the change in use rules, and when we think of properties being disposed of, we obviously think of when a property is actually sold to an arm's length buyer on the open market. But there may also be a deemed disposition of property when there is a change in use of that property, and those change in uses occur when you have a property that you've used as your principal residence, and then you start to rent that property out to a tenant, or you might start using that property on Airbnb as a short-term rental. When that change in use occurs, you're deemed to dispose of the property at fair market value. And so it can create the reporting, when that change in use happens, it can create the principal residence exemption reporting on your return. An alternative, though, is there are elections available, one called the 45-2 election, which makes reference to the section of the Income Tax Act that would allow you to defer that deemed disposition for up to until you actually sell the property and allow you to claim the principal residence exemption for 4 more years, even though you may not be ordinarily inhabiting the property. On the flip side, there are similar change in use rules again when the property that you may have used as a rental property starts to become your principal residence. Again, there would be a deemed disposition at fair market value. So if there has been any increases in value during that time while it's been a rental property, there may be a capital gain. And in addition, there is a similar election, kind of the sister election to a 45-2 election called a 45-3 election, that can allow you to defer the disposition again until the property is sold. It's important. One of the criteria for the 45-3 election is that no capital cost allowance has been claimed on the property, or capital cost allowances are also commonly referred to as depreciation. So where taxpayers have moved in and out of a property, or they have a rental property that they may consider moving into in the future, the consideration of whether they will claim depreciation on a particular property becomes important, because if depreciation has been claimed, then this 45-3 election is something that cannot be filed. The most common scenarios where we see these change in use rules apply is someone's living in their home. Maybe they are moving abroad to work for a few years, and then when they move back in. It can also happen in instances where there may be a triplex and you're living in one of the units and you move out of one of the units. That's and also a common scenario that we see the change in use rules. But each case would need to be analyzed on its own to determine whether these would apply. And our advice is typically, if you're ever moving out of a property or into a property that has previously been rented, that you get tax advice, and whether to file these elections is something that's looked at on a case-by-case basis. Another not quite a new tax rule for 2024, these anti-flipping rules were introduced as of January 1st, 2023. But these rules were essentially introduced to treat any gain from a property that has been held for less than 365 days as business income rather than a capital gain. And if these rules apply, so you've sold a housing unit in Canada that you've owned for less than 365 days, any appreciation would be treated as business income instead of a capital gain, and you would not be able to claim the principal residence exemption against that profit that you made. There are exemptions to these rules as a result of certain life events, such as the death of a taxpayer, a breakdown of marriage, separation, or divorce, whether someone has moved from one city to another, or being losing someone's job. Those are some examples of certain life events where, if you are forced to sell your property within 365 days, that the capital gain may not be treated as business income. I will caution that there are, other than the 365-day rule test, there are no other explicit rules in the Income Tax Act that say whether a disposition of property is business or capital gain income. However, it has been something that has been established in the courts and with CRA for a number of years, and there's a number of cases on this issue. So even if you sell a property uh, that you have bought with the intention of flipping, even if you sell that property after 365 days of ownership, the profit may still be considered business income. It's not automatically considered capital gain income if it is sold after 365 days. And since these rules are relatively new with the anti-flipping, we would probably expect this to be an area of focus for CRA in the coming years. So with that, I have one more question, another question in terms of deduction. So what is the tax savings a taxpayer would receive when claiming a deduction on their tax return? So split here. Nope. So the correct answer the correct answer is that it depends, and it depends on your marginal tax rate. So a deduction reduces your taxes. A tax credit is based on the lowest federal income tax rate of 15%. So there's a distinction there between a tax deduction and a tax credit that individuals receive. I'll go through some common deductions that we advise people on, one such being interest. And like anything else in taxes, there are certain criteria that needs to be met for interest to be deductible. The main one being that there, of course, needs to be an obligation to pay interest, but the borrowed money that you're paying interest on also needs to be used for income producing purpose, either from business or property. And of course, the interest deducted must also be reasonable. So the prevailing market rates are usually what is used when establishing what is reasonable. Going back to the purpose of earning deducting interest, and there needed to be a purpose of earning income from a business or property. That means that the interest you pay on your principal residence, because you're living there and there's no rental use from it while you're living in the property, the mortgage interest you pay would not be deductible. However, in interest that you pay to invest money in the stock market would be if you're buying and selling securities. So one such option is to consider restructuring your borrowings to consider to have the interest be deductible as pay off your mortgage and then borrow money to invest in the market if you have an investment portfolio currently. Some other deductions that we see quite often are childcare costs, moving expenses, and support payments. Childcare costs are need to allow the individual to earn income, and those childcare costs are claimed by the individual with the lower income and up to 2/3 of their earned income. There are prescribed rates for how much could be deducted per child or the actual amount of the expenses, whichever is less. Moving expenses for moving expenses, you need to move 40 kilometers closer to your new place of work from your old residence. And there is a simplified and detailed method. So if it is quite a cross-country move, but there's relatively few expenses you've incurred, the simplified method is something that may be beneficial because it is a prescribed rate per kilometer instead of keeping all your receipts for the detailed method. Support payments, spousal support is deductible where child support is not. That's also because spousal support is included income and child support is not. The both the for the spousal support to be deductible, it must be pursuant to a written agreement, and that would usually be in your separation or divorce agreement between former spouses. Individuals will pay a number of fees to earn income as well. So accounting fees, those are deductible against investment, rental, or self-employed income. Same with investment management fees that are paid. Those would only be for non-registered accounts. So if there are investment management fees paid within an RSP, RIF, or TFSA, the fees related to those accounts would not be deductible. And lastly, quite possibly the most common one, but RSP contributions. The RSP contribution period for 2024 just passed at the end of February. But it is an important reminder that if you have made any RSP contributions in January and February of 2025, those would be deducted on your reported and deducted on your 2024 personal income tax return. So not quite a deduction, but something that benefits individuals is pension splitting, and that allows for an equalization of income between two spouses if they're receiving pension income. So if one spouse has, as an example, $150,000 of income and another has $50,000 of income, and there is pension that they can split, it can shift income from one. It shifts income from one spouse to another. Eligible pension income for individuals over 65 would be any RIF payments that they receive, RSP withdrawals, government pensions. Those are all eligible amounts for pension splitting. And not only may it decrease income tax in the current year, but it may also reduce installment requirements for future years if the pension splitting allows for an individual to get under the threshold for needing to make installments for the year. And our last topic of the day is talking about the disability tax credit. I've listed some common conditions on the screen here, and I'm just, as you see them, if any of these would be eligible for the disability tax credit. So again, all of these conditions have the possibility to be eligible for the disability tax credit. The disability tax credit is for individuals that have a severe and prolonged mental or physical impairment. And the way to apply for the disability tax credit is your doctor or medical practitioner would fill out a form called the T2201, and that form gets sent to CRA after it's been completed for CRA to review and approve. If the form is approved, it may be retroactive to when the impairment of the individual began. So if it's something that has been ongoing for a number of years, it would be worthwhile to potentially go back and amend prior tax returns if the disability tax credit has been approved. And it can be transferred from one individual to another. So if it is a child of someone who is the one with the disability, and they do not need to file a tax return because they don't have any income and they're not going to be using that credit, it can be transferred to one of the parents that would then be able to make use of the credit. And one other item related to the disability tax credit is that it would allow you to open a registered disability savings plan for that individual. And in 30 seconds or less, I'll let everyone know that for record keeping requirements, there is a requirement to keep your tax records for 6 years from the end of the last year that they relate to. There are a couple exceptions listed on the screen, namely if you have bought property and you need to report a capital gain in the future, those documents from when you bought the property would need to be kept. Or if there are notice of objections filed or tax returns have been filed late, the time that you need to keep your records may be extended. And paper or electronic are accepted. Any documents that you have related to your tax return, I'd recommend keeping in a safe and secure place, and keep backups as well for your tax records. So with that, I want to say thank you to everyone that joined today. I realize we went to a little bit over time. We do share updates on LinkedIn of any future webinars, as well as any updates on additional topical tax topics. So if you'd like to receive more information from us, you can follow us on LinkedIn. And if you ever wanted to watch this video again, or previous webinars, they are on YouTube, and you can refer back to them. So the questions, I'm just going to.
Well, I don't think any questions have come in. I don't know if anyone in the audience has any, but feel free to post those in the chat now. We'd be happy to address them. One kind of closing comment I'd like to share is that I think all the topics we covered today, we did at a relatively high level to kind of hopefully leave everybody listening in with a bit of a flavor of, here's some things that can give me significant tax savings. But we cover them off reasonably quickly. So if anyone listening has questions, please don't hesitate to reach out about your specific circumstances to either Nick or I directly, and we'd be happy to try and help as we can.
I think I saw one or two questions come through Menti. I think one was related to if there is an age limit for transferring the disability tax credit from a child to a parent. There isn't necessarily an age limit, but the under 18 years of age, they're typically living with you. Adult children can transfer the disability tax credit to a parent if they are considered a dependent, and that usually means that the adult child is living with the parent as well. So it is possible for someone over the age of 18 to also transfer the disability tax credit to a parent. Again, case by case, but it is possible. And RSP, and I think I saw one about RSP income for pension splitting. RSP income withdrawals from an RSP, if you're over the age of 65, would be eligible pension income.
And just on the point of the age restriction on transferring the disability tax credit, the other area we see quite often is like an aging parent who maybe becomes reliant on their child for care or whatnot, that aging parent can actually transfer their disability credit to their child in that circumstance. There's a good question came across, and the question is, when counting capital gains over the years, do we have room to adjust on the effect of inflation through those years? And the short answer is no. The longer answer that I would give is that historically, when you kind of look and say, well, why is there a 50% inclusion rate on the capital gain? Like, why isn't it 100%? And I think a lot of folks would argue, well, that a lot of the gain that people realize on an asset over its lifetime, a lot of that is inflationary, right? And so I think part of the rationale for the 50% inclusion rate is to account for the fact that it's kind of unfair to tax somebody on inflation in the economy, right? And so that would be a justification in my mind why the 50% inclusion rate certainly makes sense. But aside from that, there's no ability to somehow inflation affect your gain. It's kind of is what it is, unfortunately.